Picture this: a brilliant mind, armed with a prestigious degree and years of experience, loses everything to a decision that, in hindsight, seems baffling. How does this happen? Why do people who excel in every other aspect of life falter when it comes to money? What if the answer lies not in logic or expertise, but in human behavior's quiet, unspoken influence? Let's talk about something you've probably never questioned. Wealth isn't built on perfect spreadsheets or winning strategies. It's shaped by something far more personal: your decisions, your emotions, and how you manage both in moments of uncertainty. Here's a fact that will change how you think about money forever. Morgan Housel, author of The Psychology of Money, argues that the most potent factor in creating wealth is not intelligence, strategy, or even hard work. It's patience. Patience, an unassuming force that most people overlook, is the key to growing and keeping wealth. But what does that mean for you? And how do you apply it? Today, we'll explore this idea in ways you've never thought of before, unraveling the hidden truths behind our choices about money. Picture this: a wealthy executive stands on the balcony of his sprawling mansion, overlooking the city lights below. To the world, he's a symbol of success, a self-made genius who conquered the odds. But at the exact moment, just miles away, a quiet janitor finishes his shift, carefully putting away his broom. To anyone watching, he's just another face in the crowd, invisible in the shuffle of life. What if I told you that this janitor, with no college degree and no high-paying job, would amass a fortune of over $8 million by the end of his life? Meanwhile, the executive would lose everything with every advantage money could buy. It's a story that isn't about intelligence, connections, or luck. It's about something far simpler yet more elusive: how we think about money. These aren't just isolated stories. They're clues, puzzle pieces in a much larger picture that reshapes how we understand success, failure, and happiness. And at the center of it all is a single question: why do some people make money work for them while others, despite their best efforts, end up trapped by it? The answer, as you're about to learn, has very little to do with numbers or spreadsheets. This is the essence of A Psychology of Money by Morgan Housel, a book that challenges everything we think about wealth and behavior. Over the next 40 minutes, we'll unravel 20 lessons that could forever change how you see money. But first, let's understand what this book is all about. Today, we're exploring The Psychology of Money by Morgan Housel, a collection of stories and insights that go beyond the mechanics of earning and saving. It's not a financial playbook filled with investment formulas or complex strategies. Instead, it's about understanding the hidden forces that drive our decisions, our emotions, experiences, and the unpredictable ways we react to wealth and loss. This book is for anyone who has ever questioned why people make their choices with money. Why do some people live in quiet abundance while others chase more and more, only to find themselves empty-handed? Through real-life examples and deeply human lessons, Housel shows us that how we think and behave around money matters more than what we know. If you've ever wondered why some people seem to effortlessly thrive financially while others constantly struggle, this book offers answers far more profound than numbers. And the best part? These lessons apply to everyone from the janitor to the billionaire, and everyone in between. Let's begin with a first timeless lesson, one that may change how you see every financial decision you've ever made. No one is crazy about money. Imagine two people standing side by side. One grew up in a home where every dollar was stretched to its limit. The fridge was never complete, and every unexpected bill brought a fresh wave of panic. They learned early on that money was fragile, easily lost, and rarely enough. Now, as adults, they hold onto every penny, choosing security over risk and saving at the expense of enjoying their hard-earned success. Next to them is someone who grew up in a different world. Their childhood was filled with abundance, family vacations, new clothes every season, and a sense that the future was always bright. They saw money as a tool for freedom and opportunity, not something to fear. Now, they spend freely, confident that there will always be more, and willing to take risks that might seem reckless to others. Here's the fascinating part: neither of them is crazy. How we think about money is shaped by the world we grow up in and by the moments that stay with us, whether we realize it or not. Morgan Housel calls this the foundation of financial behavior. Our personal experiences act as a lens, coloring every decision we make. For one person, holding on to cash feels like survival. For another, spending boldly feels like living. Neither is right or wrong, they're just different. Take the example of someone who lived through the Great Depression. They might see the stock market as a dangerous game that could wipe out everything they've worked for in the blink of an eye. Contrast that with someone who entered adulthood during a booming economy, where stocks only seem to go up. For them, not investing feels like leaving money on the table. And it's not just individuals. Entire generations carry these invisible scars. Someone born in a time of high inflation might forever mistrust cash, while those raised in an era of stability barely think about it. The lesson here is profound. What seems irrational to one person can feel entirely logical to another simply because of where they've been and what they've seen. We all live in our financial bubble, shaped by experiences as unique as fingerprints. This is why financial advice often feels frustrating or out of touch. What works for one person, a bold investment, a risky move, can be the downfall of another. And what feels safe to one might seem unbearably cautious to someone else. To understand money, we must first understand ourselves and recognize that no one's choices are made in a vacuum. They're shaped by the stories we've lived, the lessons we've learned, and the fears we carry. But there's another force at play, one that can be even more powerful than our own experiences. It's the fine line between luck and risk, two sides of the same coin that can define financial success or failure. Let's explore what happens when these forces collide. In 1968, a private school in Seattle made an unusual decision. Using the proceeds from a rummage sale, they purchased a computer, a rarity at the time. That choice gave a young student, Bill Gates, access to a resource that few people in the world had. Decades later, Gates admitted, if there had been no Lakeside, there would have been no Microsoft. But Gates wasn't the only young talent at Lakeside. Kent Evans, his close friend and classmate, shared his passion and ambition. Together, they planned a future where they'd lead companies and change industries. Those plans were cut short when Evans tragically died in a mountaineering accident before he could graduate. Two lives, equally bright with potential, took drastically different paths. Gates became one of the most successful entrepreneurs in history. Evans became a memory, his future decided by a moment of risk. Luck and risk are inseparable forces that shape outcomes in ways we rarely acknowledge. For every Gates who succeeds because of an unlikely opportunity, there's an Evans whose story ends because of circumstances no one could control. In the world of finance, these forces are everywhere. One investor might find themselves in the right place at the right time, reaping extraordinary gains. Another, using the same logic and strategy, might face a downturn that erases their savings. The problem lies in how we interpret these outcomes. We celebrate winners, assuming their success was entirely earned while judging those who fail as reckless or unskilled. But success often owes as much to chance as to effort, and failure is just as likely the result of risks materializing rather than poor decisions. Morgan Housel argues that understanding luck and risk can teach us to approach life and money with humility. When success comes, gratitude should follow. When failure strikes, it deserves grace, not blame. Above all, the unpredictability of these forces reminds us to protect what we have. Build a buffer. Prepare for uncertainty. Because while luck might bring opportunity, risk can take everything away just as quickly. Sometimes, even when fortune smiles on us, it isn't enough. There's a point where ambition can turn destructive, where the pursuit of more becomes a trap. Next, let's explore what happens when the goalposts keep moving. How much is enough? For most of us, there's a moment when we imagine we'd finally feel satisfied, when the work, the risk, and the sacrifices would pay off, and we could say, this is enough. But for some, that moment never comes. Take Rajat Gupta. Born in Kolkata, India, Gupta rose from a childhood of hardship to the pinnacle of success. He became the CEO of McKinsey & Company, the world's most prestigious consulting firm, and built a fortune estimated at $100 million. But it wasn't enough. Surrounded by billionaires on the boards of Goldman Sachs and other influential companies, Gupta began to feel out of place. He wanted more, not for survival or comfort, but to belong to an even higher circle of wealth and power. 2008, during the financial crisis, Gupta sat at a Goldman Sachs board meeting where he learned Warren Buffett would be investing $5 billion in the bank, a move that would stabilize its future. Minutes after the meeting ended, Gupta called a hedge fund manager and shared this privileged information. The hedge fund manager made millions. Gupta, on the other hand, lost everything. Convicted of insider trading, he went from global leader to disgraced prisoner, his reputation destroyed. Now consider Bernie Madoff. Before his Ponzi scheme came to light, Madoff was already a successful and legitimate businessman, running a market-making firm earning tens of millions annually. He had wealth, prestige, and respect in the financial world. But for Madoff, that wasn't enough. He wanted more. So, he created an empire built on lies, defrauding investors of billions over decades. When the truth finally came out, it wasn't just his wealth that vanished. The trust of thousands of families, the legacy of his name, and his freedom were gone, too. What connects Gupta and Madoff isn't greed in the usual sense. It's the endless ambition to chase a moving target. When the goalpost keeps shifting, success becomes a game you can never win. And in trying to reach for what they didn't need, they risked and lost what they couldn't replace: their integrity, relationships, and sense of self. Housel warns us that this mindset isn't reserved for CEOs and fraudsters. It's something many of us face in more minor ways. We achieve something, a job, a house, a level of income, but instead of feeling satisfied, we raise our expectations. We compare ourselves to those who have more and convince ourselves that we're falling behind. This is the danger of never defining enough. Without boundaries, ambition turns from a tool into a trap. The key, Housel suggests, is learning to stop chasing the next milestone long enough to appreciate what we already have. Because if we don't, the cost of always wanting more can far outweigh the rewards. But ambition isn't the only force shaping our financial choices. Often, what separates success from failure isn't intelligence or effort, it's time. In the next chapter, let's explore the quiet power of compounding and how small actions today can create extraordinary results over the long term. In the world of finance, there's a force so powerful it borders on magic, yet it's often overlooked, underestimated, or misunderstood. This force doesn't rely on complex strategies or extraordinary intelligence. It's something anyone can harness, yet few truly appreciate its potential. Let me tell you about Warren Buffett. Today, his name is synonymous with wealth, wisdom, and financial success. But the true marvel of Buffett's fortune isn't the businesses he bought or the deals he made. It's how long he's been making them. When Buffett began investing seriously at just 10 years old, he wasn't aiming for overnight success. He played a long game. By the time he was 30, he'd already amassed a net worth of $1 million, no small feat, but hardly the billions we associate with him now. Here's where it gets interesting. At 50, Buffett's fortune was about $300 million. A staggering amount for most people, but nowhere near the $84 billion he's worth today. What changed?
Time.
Buffett didn't just invest well, he invested consistently for over 7 decades. The power of compounding, where growth builds on itself year after year, did the rest. If Buffett had started investing in his 30s instead of his teens, or if he had stopped in his 60s to enjoy retirement, his fortune wouldn't even crack $20 million. Now, think about that for a moment. Buffett's skill as an investor is undeniable, but the real secret to his success is time. The longer you give compounding to work, the more extraordinary its results become. Small, steady growth, year after year, leads to outcomes that seem almost impossible when viewed in hindsight. This is why starting early and staying consistent matters so much. Even modest gains, when compounded over decades, can create wealth beyond imagination. Yet most of us overlook this because compounding isn't intuitive. It doesn't show its full power in weeks or months. Its brilliance only becomes clear across years and decades. Buffett's story isn't about stock picking or market timing. It's about patience. It's about letting time do what no strategy ever could. Asterisk. But creating wealth is only half the equation. The real challenge is keeping it. History is filled with stories of fortunes built on bold risks, only to be wiped out in moments of overconfidence or neglect. Let's explore what it takes to get wealthy and stay wealthy. Jesse Livermore was one of the most brilliant traders of his time. Born in 1877, he mastered the stock market at a young age, amassing a fortune that would rival today's billionaires. In 1929, as the stock market crashed and the world plunged into the Great Depression, Livermore made a bold bet against the market. When others lost everything, he walked away with a profit equivalent to $3 billion in today's dollars. But Livermore's story didn't end there. Despite his immense success, he couldn't hold onto his wealth. Overconfidence, risky trades, and the inability to adapt led to his downfall. By the end of his life, the man once hailed as a financial genius was broke, a cautionary tale for generations to come. What happened? Livermore mastered making money but underestimated the challenge of keeping it. Getting wealthy and staying wealthy are two very different skills. Getting wealthy often requires taking risks, being optimistic, and seizing opportunities. But staying wealthy demands nearly the opposite: caution, humility, and an acute awareness of what can go wrong. It's about protecting what you've earned, building a margin of safety, and never assuming the good times will last forever. Housel emphasizes this distinction because it's where so many fortunes are lost. People take the same bold risks that help them succeed, failing to recognize that once you've built wealth, the rules change. Success invites complacency, and complacency invites disaster. The key to staying wealthy isn't just financial, it's psychological. It's about resisting the urge to chase bigger wins and risk everything for more. It's about knowing when to stop, when to be content, and when to safeguard what you've already achieved. Time can build extraordinary wealth, but only if we respect it. In the next chapter, let's explore how small wins, repeated consistently, create financial freedom and independence, the ultimate prize for anyone striving to master money. Success often hinges on a single factor most people overlook: outliers. In life, business, and especially finance, the rare and extraordinary events, what Morgan Housel calls tails, drive most of the results. Think of it this way. In baseball, a player's batting average reflects every hit and every miss. But it's the home runs, the game-changing swings, that make a player legendary. The same principle applies to wealth. Consider stock markets. Over decades, most stocks have delivered modest or even negative returns. But a small number, less than 10%, generate most gains. These are the tails, the rare winners that define long-term success. For investors, this means enduring losses and average results, waiting for one of these exceptional opportunities to pay off. Take companies like Amazon. It was a risky bet in its early years, dismissed by many as an overhyped online bookstore. Yet for those who stuck with it, Amazon's meteoric rise transformed portfolios, turning a handful of shares into life-changing wealth. The lesson is clear. Patience and persistence are essential because most success comes from a few big wins. It's about being in the game long enough for those rare moments to unfold. But success isn't just about achieving financial milestones. What we do with that success and how it changes our lives is the real measure of wealth. Let's explore the concept of freedom, the ultimate reward of financial independence. What's the actual value of money? For many, it's not about luxury cars or extravagant homes. It's about control, the ability to wake up and decide how to spend your day. Housel argues that financial independence is the ultimate form of wealth. It's the power to walk away from a job you hate, to spend time with your family, or to pursue a passion without worrying about bills. Imagine two people. One earns a high salary but works 80 hours a week without time to enjoy their life. The other earns far less but has savings and the freedom to choose how they spend their time. Who's wealthier? For most of us, it's the person with control over their life, not the one chained to a paycheck. True wealth isn't measured in numbers, but in time and choice. And it's a reminder that the goal of financial success isn't just accumulation. It's independence. But even with independence, there's a trap many of us fall into: seeking admiration through wealth. Let's examine why possessions don't bring the respect we crave and how to see through the illusion. A man pulls up in a sleek sports car, the kind that turns heads and draws envy. People watch him, admiring the car's beauty, power, and price tag. But here's the irony. They're not thinking about the man behind the wheel. They're thinking about how they'd feel driving it. This is the man in the car paradox. Housel explains that we often buy expensive things, not for ourselves but for the admiration of others. Yet the admiration we crave rarely comes. People might notice the object, a car, a watch, a house, but seldom connect it to us. So why do we chase these things? Because we confuse possessions with respect. Owning something impressive will make others value us more. But genuine respect comes from who you are, not what you own. This paradox is a powerful reminder to question our motivations. Are we buying something because it brings us joy or because we hope it will make others see us differently? Wealth isn't what we flaunt. It's what we don't see. The next chapter reveals the power of invisible wealth and how saving, not spending, creates lasting financial security. Ronald Red was a janitor and gas station attendant who lived a quiet, unremarkable life. He wore old clothes, drove a used car, and chopped firewood. No one suspected he was a millionaire. But when Red passed away at 92, he left behind a fortune of over $8 million. How? By saving consistently, living frugally, and investing in blue-chip stocks. Reed's story is a lesson in the power of invisible wealth. True wealth isn't flashy. It doesn't announce itself in designer clothes or luxury cars. It's the savings that grow quietly over time, the investments that compound in the background, and the financial security that allows you to sleep at night. Housel reminds us that what we see, lavish lifestyles and expensive possessions, is often misleading. The real mark of wealth is the freedom and security it provides, not the image it projects. Invisible wealth begins with a simple habit: saving. In the next chapter, we'll explore why saving, even without a specific goal, is the foundation of financial success. Saving money is one of the most straightforward yet powerful financial habits. It doesn't require a high income or a detailed plan, just the willingness to set aside a portion of your earnings. Why is saving so powerful? Because it gives you options. It creates a buffer for life's uncertainties, a foundation for future opportunities, and the freedom to choose without fear. Housel argues that saving isn't about the amount but the habit. Even small savings, when compounded over time, can grow into something substantial. And you don't need a specific goal to start saving. The act builds security and flexibility, which are invaluable in an unpredictable world. So, whether you're saving for a rainy day or a brighter future, remember this: every dollar you save is a step toward financial freedom. Practical lessons like these are the foundation of financial success. But there's more to explore: ideas that challenge our thinking about risk, rationality, and the unexpected. In the next part, we'll uncover lessons that reshape how we approach money and life. Picture two people making the same financial decision. One uses a spreadsheet, carefully calculating every variable, aiming for the most logical outcome. The other relies on instinct, choosing a sustainable approach that aligns with their comfort zone. Which one will succeed? Morgan Housel suggests that the answer isn't as clear-cut as we think. While logic is essential, the most successful financial decisions often balance logic with reason, because reason reflects the human side of money. Take investing, for example. The rational choice might involve strategies that demand precise timing or high risk to maximize returns. But the reasonable choice acknowledges the emotions involved: fear, uncertainty, and the need for stability. It prioritizes what works in real life over what works on paper. Consider a person choosing between paying off a mortgage early or investing the same money in the stock market. Mathematically, the market might offer higher returns. But if paying off the mortgage brings peace of mind and reduces stress, that decision is perfectly reasonable, even if it's not the most efficient use of funds. Housel's point is simple: we're not robots. The choices that align with our emotions and values are the ones we will most likely stick with. And in the long run, consistency beats perfection. But even the most reasonable decisions can't account for everything. Life and markets are full of surprises, and those surprises often shape our financial stories. Let's take a closer look. What's the one thing we can count on regarding life and money? That nothing will go exactly as planned. Think back to the significant financial events of the past few decades: the tech bubble, the 2008 financial crisis, the rapid rise of cryptocurrencies. Almost none of these were widely predicted, yet they reshaped economies, industries, and lives. Housel argues that the most significant risks and opportunities come from things we don't see coming. It's not just about market crashes or booms. It's about personal events, too. A sudden medical bill, an unexpected windfall, a career change you never anticipated. The lesson here is profound. We can't predict the future, but can prepare for it. We should build flexibility into our plans instead of forecasting every twist and turn. That flexibility isn't a weakness. It keeps us standing when the unexpected happens. Flexibility requires preparation, which brings us to the next idea: creating a margin of safety. Let's explore why leaving room for error isn't just wise, essential. Imagine walking a tightrope without a safety net. One misstep, one gust of wind, and the consequences could be catastrophic. Now imagine walking the same rope with a wide safety net below. Suddenly, every step feels more secure, every risk more manageable. This is what Housel calls room for error. It's the financial equivalent of a safety net, a buffer that protects you when things don't go as planned. Consider an investor who bets everything on a single stock. If the stock performs well, they win big. But if it crashes, they lose everything. Now, think of someone diversifying, keeping a portion of their wealth in safer assets. Their returns might be smaller, but they've created room for error, a cushion that allows them to weather storms without losing it all. This principle isn't just for investing. It applies to saving for emergencies, leaving space in your budget, and avoiding debt that's hard to repay. Room for error acknowledges that life is unpredictable, allowing you to adapt without being derailed. But even with room for error, there's one constant we must prepare for: change. Let's explore how our financial goals evolve and what that means for the way we manage money. Think back to your younger self. What were your dreams, your priorities, your definition of success? Chances are they've changed, perhaps dramatically. Housel reminds us that our financial goals are no different. The things we value at 25 might feel irrelevant at 50, and our plans today might not match who we become. This isn't a flaw. It's a feature of being human. People change, and so do their priorities. A couple might prioritize saving for a dream home, only to realize years later that they value travel or early retirement more. A professional might chase a high-paying career in their 30s, only to shift toward work-life balance in their 40s. The key is to build flexibility into our financial plans. Instead of locking ourselves into rigid goals, we should create systems that adapt with us. Because while we can't predict who we'll become, we can prepare for the journey. But change and flexibility come with a cost. Every financial choice demands something in return: time, effort, or peace of mind. In the next chapter, we'll explore the hidden costs of pursuing wealth. Every decision has a price. In the world of money, those prices aren't always obvious, but they're always there. Want higher returns? The cost might be taking on more risk. Want a bigger paycheck? The price could be longer hours or more stress. Even pursuing financial security, something we all strive for, requires sacrifices, whether cutting back on spending or delaying gratification. Housel highlights that nothing in life, including wealth, comes without trade-offs. The question isn't whether we'll face these costs, it's whether we're willing to pay them. Consider the story of someone who chases a high-paying job, sacrificing family time. They might succeed financially, but the cost is measured in missed moments, strained relationships, and regrets they can't undo. The key is understanding these trade-offs before making decisions. What are you willing to give up? What's too much to sacrifice? The answers will shape the way you approach money and life. Practical lessons like these reveal the deeper truths about managing money. In the next part, we'll explore the emotional side of finance, from optimism and fear to how we influence each other's decisions. Money is deeply personal, but it doesn't exist in isolation. The world around us influences our decisions about it, our upbringing, environment, and the people we interact with. Consider two individuals. One grows up in a neighborhood where financial stability is rare. They see families struggle, jobs disappear, and savings evaporate with the most miniature crisis. For them, money is about survival, a fragile lifeline that must be protected at all costs. Now, think about someone raised in a community of abundance. Their peers travel frequently, invest confidently, and approach money with optimism. For them, money is a tool for growth, a gateway to opportunity. Neither perspective is wrong. These individuals' environments shape both. What we believe about money often reflects the circumstances we've lived through rather than objective reality. Housel reminds us that these societal differences create a unique challenge. We often make decisions based on our experiences while navigating a world shaped by everyone else's. This mismatch leads to tension between savers and spenders, risk-takers and risk-averse individuals, and generations who see the world through entirely different lenses. The takeaway is empathy. By understanding that everyone's approach to money reflects their lived experience, we can move away from judgment and toward a deeper appreciation of how diverse and complex financial behavior truly is. But even as our experiences shape how we approach money, there's another force at work: our tendency to focus on bad news over good. Let's explore why pessimism holds such power over us. In any conversation about money or the economy, one thing always commands attention: bad news. A market crash, a looming recession, a story of someone losing everything. These headlines grip us far more than stories of gradual success or stability.
Why?
Because lousy news feels immediate. It demands our attention, making us feel as though action is required. Good news, on the other hand, is often slow, quiet, and incremental. It doesn't trigger the same urgency. Take the stock market as an example. Over decades, it has trended upward, creating immense wealth for those who stayed invested. But in the short term, it's filled with dramatic swings, days when billions are lost, and fear spreads like wildfire. These moments of panic, not the decades of growth, dominate the headlines. Housel explains that this focus on pessimism stems from our evolutionary instincts. We're wired to detect threats and react to them quickly, which makes sense in a world filled with immediate dangers. But in today's financial landscape, this instinct can lead us astray, causing us to overreact to temporary downturns or avoid risky opportunities. The key is to recognize this tendency and counter it with perspective. Progress often hides in plain sight, overshadowed by the noise of adverse events. If we can train ourselves to see the bigger picture, we can make better decisions and resist the pull of fear. Fear, however, isn't the only trap we face. Greed and misinformation can be just as dangerous, leading us to believe in things that aren't true or too good to be real. Let's uncover how this happens and what it costs. In times of uncertainty, people are often drawn to easy answers. A scheme that promises guaranteed returns. A story of someone who got rich overnight. A prediction that claims to explain the future. These narratives tap into our deepest desires: stability, success, and control over the unknown. But as Housel points out, the most compelling stories are often dangerous. When greed and uncertainty collide, the temptation to believe anything becomes overwhelming. Consider the rise and fall of speculative bubbles. Investors, driven by stories of others striking it rich, pour money into trends they barely understand. From the dot-com boom to cryptocurrencies, these moments share a common thread: people convincing themselves that the usual rules no longer apply. Misinformation plays a decisive role here. In the age of instant news, half-truths and exaggerations spread faster than ever. The more we hear these stories, the more they seem believable, even when not. The danger lies in what we're willing to risk for the promise of something better. People gamble their savings, take on unsustainable debt, or invest in scams, all hoping to achieve quick success. And when reality sets in, the cost is often devastating. Housel's lesson is simple. Skepticism is a financial skill. By questioning what seems too good to be accurate and focusing on what's sustainable, we can protect ourselves from the allure of empty promises. Human nature influences every aspect of how we think about money. But to truly master it, we must combine all these lessons, balancing logic and emotion, risk and reward, and individual choices with collective wisdom. In the next part, we'll uncover how these ideas connect to create a complete picture of financial behavior. Over the past chapters, we've uncovered lessons that reshape how we think about money. Each idea, standing on its own, offers valuable insights. But when you put them together, something extraordinary emerges, a bigger picture that connects behavior, perspective, and decisions into a cohesive understanding of what it takes to thrive financially. We learned that no one's financial behavior exists in a vacuum. Personal experiences shape our beliefs, while luck and risk weave their invisible threads into every outcome. The stories of Bill Gates, Ken Evans, and Ronald Reagan taught us that financial success is rarely just about intelligence or effort. It's often about being in the right place at the right time and protecting what you have when things go wrong. We saw the dangers of endless ambition in figures like Rajat Gupta and Bernie Madoff. Their stories remind us of the importance of defining enough before it's too late. And yet, defining enough is only part of the equation. The other is patience, the power of compounding and the quiet magic of time, clearly illustrated by Warren Buffett's journey. Practical lessons showed us how to build and sustain wealth. Tales, the rare and exceptional wins, drive success. Saving money builds flexibility, while having room for error creates a buffer against life's uncertainties. Reasonable decisions, ones we can live with emotionally, often trump purely rational ones. And finally, we explored the deeply human side of money. The influences of society, the pull of pessimism, and the danger of believing in shortcuts all shape our choices in ways we don't always see. When you step back, the interconnected lessons form a simple yet profound idea. Managing money is as much about behavior and mindset as it is about numbers. Wealth isn't just about accumulating resources. It's about understanding ourselves, preparing for the unexpected, and making choices that align with what truly matters. With these lessons in mind, we're left with a final reflection. What does it all mean? In the next chapter, Morgan Housel shares his confessions, a candid look at the experiences and beliefs that shaped this book. In the final chapter, Morgan Housel pulls back the curtain and reflects on his journey with money. These aren't grand revelations or dramatic lessons. They're honest confessions rooted in his experiences and shaped by the stories he's seen unfold. Housel admits that much of what we do with money isn't logical, it's emotional. He shares his mistakes, like selling investments too early out of fear or holding on to financial rules that didn't serve him well. He reminds us that perfection isn't the goal. Instead, progress comes from learning, adapting, and doing better over time. One of his most potent confessions is that wealth isn't always what it seems. As a young writer, Housel worked as a valet, parking cars for people who appeared rich. But as he learned their stories, he realized that many were deeply in debt, living paycheck to maintain an illusion of success. It was a stark reminder that true wealth is invisible. It's the freedom, security, and peace of mind that come from making thoughtful decisions. Housel also shares a deeply personal belief. The most valuable financial lesson is understanding what makes you happy. For him, it's not about chasing status or maximizing every dollar. It's about living where money supports his values, family, independence, and the freedom to write without constraints. As the book closes, Housel leaves us with a simple truth. The psychology of money isn't about formulas or strategies. It's about understanding human nature, embracing uncertainty, and making choices that lead to a life of meaning and fulfillment. These lessons aren't just about money, they're about life. They challenge us to think differently, act wisely, and build a future that reflects what matters most to us. The question isn't how much you'll have, it's what you'll do with it. Now that we've explored the psychology of money, we want to hear from you. Which chapter or lesson resonated with you the most? Was it the power of compounding, the importance of defining enough, or something else entirely? Share your thoughts in the comments below. And if you're passionate about learning life-changing insights from books like this, don't miss out. Hit the subscribe button so you'll be the first to discover more ideas that can transform the way you think and live. At its core, this book isn't just about money. It's about understanding yourself, your habits, emotions, and how your unique experiences shape every financial decision you make. Housel's timeless lessons remind us that wealth isn't just about numbers. It's about patience, freedom, and making choices that align with what truly matters to us. Whether you're just starting to save, navigating investments, or redefining what success means, these lessons offer a financial and personal clarity roadmap. If you've ever struggled with saving, investing, or even defining what wealth means to you, this book is a must-read. It's not just a guide. It's a wake-up call to see money differently and use it to build a life of purpose. If you found this summary helpful, imagine what the book could do. Morgan Housel's stories and insights are filled with wisdom that will stay with you for years. Grab your copy and start transforming how you think about money today. And don't forget, subscribe for more lessons like this, and be sure to comment with the takeaway that struck you the most. Together, we can keep learning, growing, and better understanding what it means to live a vibrant life.